It feels like it's been a lifetime, even though I took
We've
one
been
week off.
we've been derelict in our responsibilities.
I know. Well, you know what? It was last week. It was the 4th of July. I was traveling. I'm abroad right now. I'm coming to you live, not when you watch this, of course, but coming to you from Geneva, Switzerland. It's been a beautiful trip. We'll get into the details. Of course, Craig McGrother here, the Director of Business Development, alongside the CEO and founder of Lone Star Capital, Rob Beardsley. How are you today?
I'm good. I'm good. I'm feeling refreshed on this Sunday. Like you said before we recorded, you're excited to get back to work. Obviously, being re-energized from a vacation, I'm excited to work just because that's what time it is. So yeah, it's good to be here.
Yeah, without a doubt. Well, on my end, we'll just go into it real quick. I've probably worked more this year than any other year, and I've had my own businesses before pertaining to my residential career, this that. You see me work, so really when I put my mind to something, and my life in my 20s has just been really work, work, work. So it says something when I do truly mean that I've worked more this year than any of the year before, taken off basically no time until last week, which has been phenomenal. So I'm in Switzerland right now. Been here since about June 27th. I turned 30 about a week ago, which is crazy. Now I'm in my 30s, my new decade. I'm excited to get some grays going. I feel like my career literally has just begun. I'm in the position to thrive, and the seed has been planted, and now we're starting to sprout, and the fruits of the labor will grow. But with regards to my Swiss trip, went to Lucerne, then went to Zermatt, then went to Grindelwald, and then Stade, and now I'm here in Geneva. Be here for about a week. Be working all week here, soaking in the European sights and sounds, tastes, flavors, you name it. But those are the updates on my end. So apologies for not having some content for you last week. Of course, Fun Friday was going off. Of course, Founders Insights was being aired. But our show here is the first week we've missed since inception. But I feel so rejuvenated and recharged and ready to attack this week with enthusiasm unknown to mankind, as Jim Harbaugh would say.
Very good. Yeah, let's do it.
Cool. Well, without further ado, let's get into Houston weather updates. It's obviously a known thing that we own a lot of property in Houston. It's where the bulk of our portfolio is. And for those who've been following some news, current events, there were some storms that went through. So can you kind of touch on how our properties are doing and kind of how we prepare for moments of, weather distress and all things like that?
Yeah, so Hurricane Beryl is headed. It was kind of headed not really in Houston's direction, but then of course things work out, it turned up to the north and is now heading a bit towards Houston. I mean, it's not a red alert, but it's going to be a rainy week. We had a good amount of rains yesterday, but the real big rain should be tomorrow, Monday, July 8th. So we're prepared on Friday, on July 5th, after the 4th. We had our teams buy sandbags for first floor units. So that's just a bit of a precautionary measure, and we sent out notices to all the tenants. So we're here. We're going to stay vigilant, close to the news, and act accordingly.
So when you have sandbags, is that basically in front of doorways and such, just to make sure that water doesn't penetrate within the property itself, I would assume?
Yeah, that's right. I mean, if you think about water damage, what you don't want is standing water inside apartments. That's going to mean you're going to have to do floor repairs, sheetrock repairs, and things like that. So you want to obviously keep water outside of the apartments.
And it actually goes further than just sheetrock repair, things of that nature, but also you get mold potentially if there's water inside that penetrates. So it really does become a longer list of items if you don't kind of do the front end work. But of course, in the Lone Star Capital way, we are vigilant. We are prepared to take on and weather any storm, whether it be a turbulent debt market or a literal hurricane coming through in our beloved Houston market. So good to know that we are being proactive to reassure the investors. And I think one of the more common questions that we actually get is, hey, what type of zone is this property in? Is it really close to the water? Is it in a flood zone? We at Lone Star, of course, the evolution of the firm, we've really tightened up our buy box. We, of course, have got about 3 properties that are close to the bay, close to the Gulf Coast, right? But a bulk of our properties are actually in locations that are in the northwest pocket. We've got about 1,000 units in our portfolio in that vicinity, and then of course in other regions as well throughout Houston. But we are, on the front end, looking to buy properties, typically speaking, not in flood zones, not in areas where a hurricane or a bad weather event would really affect the property. Of course, if you're in Houston though, or even in Texas, and really most of that southeastern region of the country, you can't avoid weather events. Unfortunately, not all the weather is like where we grew up in the Silicon Valley, or Los Angeles, where the weather, only potential hazard you're gonna have are fires, of course, a natural maybe or man-made disaster of sorts, and an earthquake. But can you talk about just some things that we've looked through over the course of time and how we've changed the acquisition process for deals that we look for to buy for this exact reason?
Yeah, so the coast gets typically hit harder with weather events, and that causes insurance pricing to reprice more aggressively for those locations versus non-coastal locations. So aside from the actual damage and risk associated with weather events, it's also just simply insurance, and it's the pricing of insurance, it's the volatility of that pricing. So that's something that we want to avoid as much as we can. Insurance across the board has been a big headache for people in Texas, Florida, the Carolinas. That's been a major issue for multifamily investors. And so if we can do a little bit of due diligence or just narrow our buy box, like you said, a little bit to try to minimize those issues, that can help a lot, which is one of the reasons why we've had so much success and have been more active in the northwest side of Houston, which is actually where the bulk of the population growth is, as well as being more insulated from weather.
Awesome. And, as we move forward, I guess if there's a screamer deal, how sexy or attractive of an opportunity would it have to be for you to feel comfortable to greenlight an acquisition that might be in an area that, we maybe don't covet as much due to the weather issues?
I'd say, depending on the risk profile, 200 basis points of IRR. I think it's...
Wow.
Yeah, that seems about right.
So basically it means if we're buying a 16, it's got to be an 18 to feel like we're getting paid for a risk, for the audience and listeners who want to conceptualize that. So very interesting to hear that. So good to hear that we are taking the measures on the front end. We've got all our ducks in a row on the insurance side of things, of course, and we've got all items on the property and asset management side of things to mitigate any potential items that do come up in the event that we do have a nastier than anticipated weather event. Of course, Harvey came through in 2015, if I'm not mistaken, and a lot of our properties, of course, are older than 2015. Therefore, all the properties went through that event, and there were other weather events that were wetter than that were fine. So we do look at things like that when we do go through the acquisition process. So any investor of ours who's there, please know that we have this covered. We're being diligent. We can't control everything. Unfortunately, Rob is not God, but we will take every measure on the front end possible to mitigate any downside there. Going on to the next topic here, which is H1, the first half of the year recap, as now we're in Q3, and then H2 horizon. So really, if you think about it, so much has happened in this first half of the year. It feels as if the years get quicker and more goes on as we take on more kind of life responsibility, but kind of just break down your overall sentiment and maybe themes of the first half of the year as we kind of get a little bit retrospective here.
Yeah, it's been a great first half. We closed on 2 acquisitions, and we've got 2 more under contract. So I would say that's a fairly active acquisition pipeline considering the circumstances. Right now the market is very choppy from a capital markets perspective. It's always hard to make deals pencil, so I can't complain there, but I'll complain and just say it's hard to make deals work right now, and that's causing us to be less active and more patient, more cautious. But it's funny because I feel like we're always saying that. We're always saying it's hard to find deals right now, and we're being patient, we're being cautious. And we're saying that whether the market's up, whether it's down. So it's just interesting to experience that, because I think we've talked about this a lot, and a lot of people understand logically that right now is a great time to invest. But nevertheless, it's still a competitive market. Nevertheless, it's still always hard to get deals done. And it's just, the challenges might be a little bit different. But yeah, H1 I'd say still a big success. We've grown as a firm. We've hired some more amazing people on the team. We've shuffled around responsibilities. I'm now the CEO of Lone Star Capital. That's a really big development. I think that's going to serve Lone Star extremely well. Having me being overseeing the operational side of the business and having kind of everything, all the responsibility flow to me, so I can just better coordinate our teams and lead. So I think that's a really, really exciting thing that's going on for us this year.
Can you break down the CEO component to what will go on now that wasn't occurring before? And I guess we'll start with that.
Okay, so before, my responsibility for the firm was mostly to oversee acquisitions and capital markets. What does that mean? That means I work closely with Brad on buying new deals, underwriting, negotiating, due diligence, structuring the deal, and then on the capital market side, of course, structuring the debt and the equity and helping you and Dasha raise the equity and handle investor relations. So those are my main responsibilities. And then, of course, just obviously being a founder and working closely with Kent, I was just involved with everything else and overseeing everything else, but not really actively involved. And so moving forward, I'm now actively involved as kind of the head of asset management, head of property management. I'm here in Houston, and the focus for the next 6 months is to reimagine our property management and our asset management divisions. And we've already made a ton of changes. I spent this morning revamping our websites, so we're going to be rolling out all new websites across our 17 properties. And these websites are going to be so much better. I was telling one of our investors the other day how we're applying everything we've learned on the marketing side of things to market Lone Star Capital, and we're going to use those skills to market our properties. Marketing is marketing. So that's just kind of getting in the weeds of an example, but I feel very confident that if I have the opportunity to kind of weave my tentacles into something and I can leave my mark on it, it's going to be for the better, and we're going to not necessarily revolutionize everything, but we're going to dramatically improve processes, and we're going to be able to inspire people, and we're going to be able to get better talent to work with us, because people can work wherever they want. So we have to bring something to the table. We have to inspire them. They have to go, oh wow, I want to work for Lone Star Capital. And that had been true for a long time for the private equity side of the business. People want to come and work with us in our office in New York, and they want to work on the acquisition side or investor relations side or asset management. But the property management side was kind of neglected from a culture standpoint. And so with me being the CEO and having kind of a cohesive culture, cohesive company all together, we're able to actually leverage the effort that we've put together into building a culture, building a brand, to actually inspiring the property management level teams.
It's really interesting that you said a key word there, because I was about to say it. But now you're getting to the point of maximizing leverage, okay? Because you leveraged myself to, empower me to do my job. Basically, I would say at this point 95% autonomously, Dasha similarly, and Brad. Now you're implementing everything else on the other components of the business, minus what Kent does, which we'll get into that, of course. But it is so cool to see that you're going to be able to put your DNA all over the firm now and really max that out and become a better business person, but also understand the business at a very higher level moving forward, which if you're an investor, you should be incredibly happy about this. I really think that this is the most important thing, because of course we want to be so smart on the debt and equity side of things, acquire these properties for the best purchase price, utilize the best structure possible, find the alpha in every little nitty-gritty way. Well, if we're going to find the alpha in every little nitty-gritty way, that means you need to be now on the asset management and property management side of things, because you've kind of trained the other side of the business up as much as possible. So if you're an investor listening to this, if you're a prospective capital raiser or a partner of ours listening to this, you should be absolutely elated at the fact that Rob is getting into the weeds and getting into the, I would say maybe the more boring side of the business, at least in my eyes, and is really going to change that. So for all those listening, you should be pumped. And what you should also be pumped about, if you're an investor or a partner of ours, is now what Kent is going to be focusing on. So can you please now elaborate on that function of the business, because this is where millions of dollars will be created as well.
Yeah, Kent now, with my taking over this set of responsibilities, Kent is more free to focus on what we could just generally call special projects. And more specifically, Kent has spearheaded our affordable housing strategies. So that's how we've been successful with PFC, HFC, Chodo. We've done a lot of housing authority partnerships, nonprofit partnerships, and we also successfully closed on a REIT acquisition. We have another REIT acquisition on the way. So these are special projects. These are difficult things that are really well suited for Kent's background as a tax attorney, as well as his personality generally in terms of his ability to come up with creative structures and solutions, and he's a good person that networks well and finds the right people, and he's able to build the right team. So when we have these ambitious projects that we take on, whether it be, another thing I didn't mention is low-income housing tax credits. That's another very, very, very big element. I mean, he could just spend all his time on just that, but we've got all these special projects roped into one here. So like on the LIHTC side, you have to bring in an architect, you have to bring in a consultant, you have to have multiple different legal counsels. And so because he himself is an attorney, he's really good at working with outside counsel, because you kind of have to be an attorney to work with attorneys in a way. And like for example, on the REIT acquisition, after we closed it, we were talking with our real estate attorney as well as the, I forget what you call it, but like the REIT attorney or something, like some sort of special attorney, right? So it's like our
real liaison of sorts.
No, it was like a very niche, like real estate entity. It wasn't even a real estate attorney. It was a person who specialized in it's like a corporate law attorney because a REIT is a corporation. Anyway, so they were all three talking, and Kent was saying, like, do you think if we were just a regular client and I wasn't an attorney, like, you guys would be able to do this for me? And both the attorneys said, no, we don't think it would have been possible, which crazy, but super beneficial for us. So anyway, with him being freed up, he can just dive more deeply into these special projects, which invariably creates much more exponential value for our investors.
Well, it's also really cool because, the seeds of, what you planted a couple years ago with Dasha, Brad, and myself, we're all now in a situation where we're blooming. And then you've got, of course, Jason, Sawyer, and Joe, who's similarly on the asset management, property management function of things, where now you're really seeing, of course, our most tenured asset manager, Jason, really flourish. It's been really awesome and special to hear about his progression, as well as two new people, of course, you brought onto the team who are doing very well. So it's really fun to see that you are putting, your thoughts to that, your energy into it, and you're watching all kind of work itself out, which is very special. So it's super fun to hear about this. If you're an investor or kind of working with us or in our ecosystem, all the changes that have happened this year should make you giddy with excitement and joy that we're going to get incrementally better. And not only incrementally better, but we're going to be providing more options, more value in a condensed time period now, because we're all looking and are focusing on the functions without, I guess, maybe being micromanaged per se, but it's just all very exciting anyway, slice it. So you should be thrilled about that. So yeah.
I'll give a quick shout out also that Kent is looking to hire, I'll call it a deputy for his special projects division, because Kent is now essentially on an island alone on this special projects division. And yeah, of course, he can get my help, he can get Jason's help, which he has and stuff like that, but we really want someone that is dedicated to just helping Kent work through these special projects and handle so much that's there. So there's an open position coming here for this deputy position. So I think that's going to be a super exciting position for somebody, and yeah, we'd like to make that happen soon.
Cool. Well, I appreciate the shout out. You heard it here first. It's breaking news, and that's the first time I'm hearing it. So, if you know someone who might have that, skill set, of course, email myself, Craig@lscre.com. What would one need to have from a background perspective to be qualified and a good candidate for said position?
I would say some tax law experience would be nice, but it's definitely not necessary. Any law background would be nice, but not necessary. I would say having an analyst background. So if someone has been trained as an analyst at an investment bank or at a real estate investment firm where they have I think like transactional experience is very important, which obviously investment banking analysts, that's all they do is work on transactions. Something like that is super good. It's someone that has a good brain and has Excel ability and just is a good communicator, good coordinator, someone that I would say from a personality profile and culture index, right? And culture index is something that I want to talk a lot more about on this podcast as we work more with culture index, because we've hired them as a consulting firm now, and it's going to be super, super excited. I'm not going to hire anyone ever again without profiling their culture index profile. So for this particular role, the perfect culture index profile is someone that scores slightly above average on autonomy and someone that is, I would say, anywhere around average for sociability. They don't need to be crazy social, but it probably doesn't behoove the role to be antisocial. So just average social. And then I would say that the next one, which is deliberateness, I would say probably below average deliberateness, so a faster person, someone that new concepts click for them quickly. And so the trade-off between above average and below average deliberateness as defined in culture index is if someone is above average deliberateness, that means they are kind of slower in their work, but they're more methodical and they're not going to get bored by doing the same thing over and over again and having strong attention to detail. So that's the pros. But the cons is, of course, they're slow. So if someone is fast and they're not as deliberate, they pick up new things quickly, they move and get things done fast, but they're gonna, if you have them doing something over and over again, they're gonna get a little bored, and they also are perhaps gonna be maybe not quite as methodical, but that also can be balanced by the final trait, which is a big focus as well, which is essentially organization. And this role needs to be above average organization, big time. This person needs to be able to kind of almost be like a quarterback, because these, let's say, LIHTC transactions and other affordable housing projects and special projects, there's a lot of quarterbacking, because you've got this council and that council, and you've got the architect and you've got this consultant, and you need to just coordinate with everybody for a successful closing.
Yeah, it's a lot of moving parts. Well, I guess I'll officially take my hat out of the ring for that role, seeing as how you described it. Don't think it'd be a fit for it, but we'll carry on to the next. And I'm just happy to say this. I am on the equity side of things, and I don't want to go anywhere else. So it's a PSA. But that's awesome to hear that Kent will have someone working under him. We'll have some support and some assistance there. Very exciting about that. So thumbs up on that one. Obviously, a lot of hiring, firing, and moving around, of course. And then just as we're on the H1 side of things, do you have anything else you want to share from your perspective?
Well, this is a very last tail end of H1, and I think this is actually a huge needle mover and something that also investors should be really excited about, which is that essentially my mom has joined Lone Star full time. And if anyone...
First off, I was so excited to hear that. I think I was like, when's your mom starting? When's your mom starting? You're saying that to you and Dasha, of course. So I cannot be more thrilled to hear that she is on the team, because she has such a deep and robust level of experience. But also, we get someone now who's a little bit more seasoned. It's not that your mom is old by any means, but she obviously, skews the average age of the firm a little bit higher, which is very good.
Yeah, that's a slight benefit, but aside from that, I mean, more importantly, just she has a solid 5 years experience of being a super hands-on property manager. Because for those that know my parents, they've owned their own 2 multifamily properties that Lone Star helped purchase for them 5 years ago, and ever since, basically, originally my parents moved to the properties, lived on site, kind of exactly what I'm doing here. I'm living at one of our properties now, and my mom just took it upon herself to just learn every element of the business, go through the hiring and firing process and curating the best on-site team. She's got an amazing on-site team, top to bottom, in the office, on the maintenance side. And she learned all the accounting herself. She learned how to asset manage. She learned how to have tight controls over the operations. So she's bringing that wealth of experience to our entire portfolio. So I'm super grateful, and it's a huge, huge benefit to have her on the team, because she can just direct us to bring best practices to every single thing we do, from leasing criteria to fee schedules to accounting, reconciliations, and all that good stuff. So that's probably the biggest win for the firm.
Can we talk about Resman and her extensive knowledge to Resman? Because I hear it, and I still kind of am a little bit clueless pertaining to the subject, but she's a guru of that, and amongst many other things. So can you talk about maybe Resman, some of the other blind spots she's helping fill in the firm that maybe there's some oversight before that she's taking care of now?
Yeah, Resman is a popular, easy-to-use property management software. There's bigger names in the industry. There's Yardi, RealPage, OneSite, and stuff like that. But Resman is another one of those tools, and it also, so with a property management software, it usually has accounting built in. So, and that's a really important feature, obviously, of our business is accounting. And so not only do we, in Resman, just manage all the move-ins, move-outs, the rental rates, the deposits, the charges, there's also just a huge accounting module for Resman. And so one big project that we've done over the last few weeks all together as a team is we've reworked our GLs, and this is super nerdy and basic stuff, but it's just stuff that needs to get done, and it needs to be improved. You know, we're just not accepting mediocrity. We're not accepting B or C. We're striving for A across the board. A output, A performance, A players, and that's why nothing is safe. We're looking at all of our processes, we're looking at how everything currently is, and we're looking at improving it.
You said GL. Can you explain what GL is? Because that just went over my head.
Yeah, GL stands for General Ledger, and basically what it means is with accounting, there's a line item for every single thing, and you can determine what those line items are. So let me give you an example. If you're talking about payroll is a category, right? Payroll isn't a GL. But payroll consists of GLs. So inside of payroll, you could have the community manager's salary. You could have the bonuses. You could have health insurance. You could have benefits and things like that. So all those individual GLs are what make up the total payroll. So with reworking the GLs, it makes us more organized. And so what we've done is we've not only improved our GLs to make it much more organized, and the benefit of that is now we can, from an accounting perspective, we can see and read the financials more clearly. And as long as things are coded properly, right, it's up to the on-site teams as well as the accountants to code and reconcile properly, so that they're not taking like your salary and shoving it into like an admin cost for a property, right? Like that's jumbling things around, and then it's unclear what's actually happening, right? You need to have the insight to be able to make improvements. So with better GLs and better accounting organization, we can actually just read the numbers, and the numbers tell a story, and it's a more accurate story because of the way we're putting it together. The other really important part about this is we not only changed the GLs, we've also remapped the underwriting model to match the new GLs. So that way, our underwriting just exactly can move from underwriting to budget to performance, and then it's super easy for us to actually look at underwriting versus actual data on an ongoing basis, which is super important, obviously, because we're not in this business simply just to, rent apartments and be nice people. We're in it to have an underwriting budget, and that's our plan, that's our projections to our investors, and then every single quarter we need to go and make it happen.
Without a doubt. And speaking of underwriting, we've actually made some shifts as well too. If you look at some of our more recent deals, one thing we've done is actually not wanted to bring down payroll, right? Or some of our costs there on our expense ratio. We've actually wanted to keep it at par or maybe even raise it ever so slightly. Does that kind of fall into line of what you're kind of talking about as well as it goes to, how we do our accounting and bookkeeping on said items?
Yeah, this is more of a philosophical change that is a no-brainer when you think about it, but for whatever reason, we just weren't subscribing to this philosophy, and that philosophy is we need to have the best people on site, and the on-site teams are the most important people in our business, and specifically the most important person in our business is the community manager at each and every property, because the community manager is essentially the CEO of that property, and they are going to make or break the success of that property. So with that in mind, why would you pay your CEO of that property $50,000? That's pretty straightforward, right? If you pay them $50,000, it's unlikely that you're going to get the best that you can. Now, obviously, it depends on the location and it depends on the circumstances, but if you are willing to pay top 10%, 10% salary range, now it's not a guarantee that you're going to get somebody good, but it's more likely that if you do the other things properly in your hiring process that you can afford and will get a better person. I think this is something that I've spent a lot of time working on and thinking about and discussing, and I've shared a bit on the podcast, but I've been preaching to our teams and everything like, hey, we need to hire the best people, we need to increase salaries so that we can afford the best people. But the funny thing is about that is if you just raise your salary and now you're going out and offering a better salary, it doesn't guarantee that you hire better people, right? You can actually just get taken advantage of and you can get bad value. So it's not necessarily about paying the most, even though that's one of our goals. One of our goals is to attract the best people that are worth paying the most, because if you can afford, not even afford, but if you can hire the right person, let's say a community manager, and they make $75,000, $80,000, and they're actually good enough to where they make the property more money than what their salary is costing, then it's a win-win, right? There's no downside. It's just amazing. And that's what we're striving to do. So it requires paying the higher salary, but it also requires just spending a lot of effort in the hiring and recruiting process, not being lazy, making sure that we do the interviews, do the resume checks, do the culture index checks, do the reference checks. And with all that, we still make mistakes. And that's just the way it's going to be, and that's unfortunate, but I don't want us to be viewed as like a cutthroat firm. I think we have a very great family culture at our firm, but at the end of the day, we have to be the cliche hire slow, fire fast.
Yeah, well, it's super important, and it's the hardest thing and the kind of the most imperfect side of the business is the hiring side, right? You think about the kind of the height of the Silicon Valley area, and this was probably in 2016 to 2020, probably pre-COVID and whatnot, when the market was gangbusters, the ZERP environment, probably pre-ZERP, but kind of that come up, and what Google and a lot of these top companies were doing was they were hiring engineers and hiring people, not because they necessarily needed as much. Sure, you can always have good people there, but they wanted to hire them away from other companies and competitors to kind of have the highest level of talent around. So obviously we're not going to go to extremes like that, but making sure you have the best talent is super important. Well, yeah, it's awesome that we're attracting new talent. It's awesome that your mom wanted to step on board to be helpful, to be productive to the firm. So I guess moving forward, specifically, what will her role be? What will, I guess, maybe title perspective, if you can dive into that. Is it ongoing? I would love to hear what that sounds like and, what that will look like moving forward.
Yeah, so her primary responsibilities are going to involve overseeing the accounting for all the properties, as well as the operations that are related to accounting. And it's funny because accounting, people think about it as basically just a documentation process of what has occurred, which is true. But then there's a lot of adjunct responsibilities, such as tenant issues, like just the whole process of tenant ledgers and managing balances and credits, and if you're going to transfer a tenant or if you're going to move them out, you have to move them out, and you have to have all these policies and procedures in place to properly assess fees and to screen new tenants and things like that. So it's kind of just bringing a lot of operational control to the business, as well as more accounting control as well.
I see. Well, that's awesome. Congratulations to us for attracting more talent and bringing that on. Very exciting. I guess now, as we look forward to H2, what do you think that will have in store? Pull out your crystal ball for us, please.
So for H2, I'm seeing the long end of the treasury curve come down. I think that we've seen the peak in treasuries, and now treasuries are on their downward trend. We'll see what next week has in store for us. So I think that is going to be a benefit for fixed rate borrowers. However, for many properties, NOI is continuing to struggle. Occupancy is struggling in some places. Rents are struggling in some, not bad, just not the 10% rent growth per year anymore. So not struggling is.
Oh, you mean the unsustainable reality that we're in before, where everything was going crazy? Yes, sadly that is gone.
Yeah, so that's a little bit of a headwind, but obviously with rates coming down, that's helpful a little bit. That's not going to help floating rate borrowers yet, because I think the Fed is just delaying as much as they can in lowering rates. But I think once they break the seal and start lowering rates, they're going to lower in a hurry. I think that the forward curve, as history always proves, is wrong. People under predict how much and how quickly rates are going to rise, and then the same thing, they under predict how much and how quickly rates are going to fall. So rates are going to fall faster than predicted. It's just a matter of when, not if. And that's going to continue to make the multifamily space quite volatile. And there's also, as time goes on, the owners that are performing extend and pretend with their lender, that's going to run out on some people. So you're seeing more foreclosures take place, and you're seeing more capitulation from borrowers, capitulation not as much from lenders yet, but there's kind of rumors and talks, and at some point you have to wonder if and when lenders are going to be willing to take some sort of creative discounted payoffs and whatnot, so that they can try to keep their balance sheets clean and avoid problems on their end. But yeah, it's going to be kind of more of the same. The way I think the most important thing I want to say is just that I'd say over the next 12 months, things for the Class C space is going to get harder and harder. So if someone is an owner of a bridge loan, a deal with a bridge loan, and it's an older property, things aren't just going to magically get easier. Things will get harder. Even if SOFR comes down and floating rates come down, that's not going to just immediately alleviate all your problems. Yes, it alleviates a little bit of your debt service burden, but your ability to refinance doesn't really change much. That's going to be more so based on the long end of the curve, and a lot of people are so far out of the money that it just doesn't really, the rate moves are not going to save them. So that's what's happening. I think the buying opportunities are just still going to be there for the next 12 months in the B and C space. But the A space, on the other hand, I think that opportunity is closing quickly. I think the best time was
it's actually
6 months ago.
Yeah, well, to your point, Brad is, in my ear. We always are talking about deal flow coming up, what's going on, and he's got brokers that are really in his ear saying, "Listen, these B deals are coming up right now. Some deals are, trading at paper. For those who do or do not know what that means, trading at paper or below paper means the loan amount is X." And the property is worth either at loan amount or below loan amount, which means there needs to be a workout, or all the equity in the deal has been evaporated, meaning investors have lost all their cash in the deal, and or the owner is basically paying you to buy the property, essentially, with a workout of sorts, potentially. So B deals might be a little bit sexier. What constitutes as a B deal? Well, it's probably in maybe a second-tier neighborhood, and then also it's probably going to be a property that's older than 90s, okay? So I know that everyone wants the newer, sexier, 2000s newer deals at this point, but if you really want to get paid for your efforts, we and you as an investor probably need to be looking at some stuff that's more distressed potentially, which is that 80s, maybe even 70s potentially, like the deal that we're buying right now, of course, in Dallas, Green Riviera. But these are the opportunities that are going to come up right now, so brace yourselves for this. And also another theme I want to talk about right now is if you do invest in distress, it would be silly to not assume that the takeover process in the first 6 months to a year will also feel distressed and uncomfortable as an investor when you look at reporting. So just PSA to everyone out there as an investor, it is not all rosy, and sometimes there is turbulence in these processes.
Correct. Yeah. So we'll continue to make the best of the market. There are plenty of opportunities, and I think it's just a very exciting time. We all know it. The hard challenge is definitely on raising equity because you talk to investors and they have emotions. They just got capital called or they just lost money, and it's very difficult for someone psychologically to just double down and invest right now, even though logically they know. I mean, I was on the phone with a private equity firm that's a JV firm, and he said, yeah, I know that right now is a good time for common equity, but we just can't do it. Our investors are burned on a couple of our bad deals, and we just can't do it anymore at this moment. So that's what feeds and perpetuates these cycles. Is even though everyone knows that you got to buy low and you've got to sell high, psychologically it's very difficult to do because guess what happens when things go low? You also get hurt. So it's hard to double down. So right now it's just about keeping our heads down and just continuing to invest and move forward.
Not only is it the best time to invest right now, but when the market's distressed, when you want to invest. But unfortunately, when things are down like that, it's not just one thing that's down. It's probably the economy that's generally down. People are obviously a little bit more holding tight on their dollars than they were before when the economy was super fluffed up, right? So that's also another factor that we've got to push through and deal through right now is, conveying to people why now is the time and why, this deal will work out, better than projected potentially and all things like that. So it's the unfortunate reality, equity raising is getting harder and harder, although allegedly from all the articles I'm seeing, it's, JV dollars are kind of flowing back into the market. But in my conversations in, Rhode Island and Dana Point, I just, really, I'm struggling to believe that narrative until I've seen it more truly. I do think that, of course, deals are getting done. We're getting them done. We're getting them raised. It's a bit of a struggle, but, what's life without a little bit of a challenge? And in a couple years from now when raising is easier, it'll be that much more fun. Interesting conversation, or I guess email that we got from one of our investors. It was a Wall Street Journal article, and maybe Rob, if you can screen share right now. I'm not at a beautiful situation where I can kind of navigate all items, but one of our incredible investors, shout out to you. I'm going to email you back after this recording now, letting him know that'll be addressed on the podcast. But it was a Wall Street Journal article pertaining to why multifamily real estate is struggling right now. The title of it, actually, just for those who want to look it up, is apartments could be the next real estate business to struggle. So we're going to answer his question here. We're going to cover it. I know you looked through it, Rob, so kind of give us your raw Beardsley 2 cents on the subject.
Yeah, I'm not going to share my screen because it's actually, the one you sent me is from the New York Times, and my dad sent me the article on Yahoo, so I read it on Yahoo the other day. But anyway, I don't pay for the New York Times. I wonder why. But this article...
Well, you're just not a real New Yorker.
Yeah, exactly. This article to me is kind of banal. It's just more of the same. It is talking about the distress in commercial real estate and how apartments are not immune to that distress. Obviously, we all know the narrative surrounding office and how COVID, work from home, and overbuilding are essentially, aside from overbuilding, but we have secular change occurring in, people are arguing that it's secular. I don't know if it's truly secular, but people are arguing that office and the way people office is changing forever. I don't necessarily agree. I think a good, nice recession will whip people back into shape, and people will be begging to go back to the office. None of this work from home crap and, I need my mental wellness day, and I need Fridays off and casual Fridays and work from home Fridays and lay out and suntan on the beach or on the grass in Austin day. None of that. Let's get a nice recession to get people back in the office. So
yeah, and also appreciating their job once more.
Exactly. Yeah, exactly. So this article talks about commercial and how office delinquencies are very high, but multifamily delinquencies are ticking up as well. Every month there's more people that are not able to or decide not to pay their mortgage. And that is not a good thing, but this is just the reality of the situation. In 2021 and into 2022, commercial real estate, including multifamily, was over-levered. And those losses exist. They just haven't been assigned yet. So someone is going to lose money. And obviously equity is the first in line to lose money, but lenders are also going to lose money here. It just has to happen. It's just, that's what a bubble is, and that's the top of the market. And so for the least scrupulous of lenders and owners, there's going to have to be losses that are assigned. Right now, they've been kicking the can, and losses, when I say haven't been assigned, is, on paper, the property is worth $40 million, but the loan is $45 million, right? So the lender, on paper, lost $5 million. But until those losses are actually recognized, everyone can kind of just kick the can and keep things going. So we're in the second phase now of this commercial real estate market downturn. And this second phase is marked by people actually stopping the extend and pretend and recognizing some of these losses. So we've seen some foreclosures, and we're seeing that next phase start to take place. So for me, this article is kind of just more of the same. We knew this was coming. We just know that this is a slow-moving train, and we're watching it day by day, like we've talked about so much on this show.
Yeah, well, when you're in the weeds of it, it's a lot more, I guess, maybe simplistic for us, because we see it all the time, and obviously this is a very nuanced business, and even within multifamily real estate, multifamily is very nuanced. You've got A deals, B deals, C deals, you've got different marketplaces, you've got different dynamics. Some areas it's really easy to build, some places it's impossible to build. You've got, politicians and politics coming into play, right? So there's so many variables that go into these opportunities. It's not a one-size-fits-all, but listen to this podcast to be ahead of the curve and hear the best information in real time, of course. Rob, any final thoughts before we depart from the podcast today?
No, I think finishing with the market talk is always interesting. It's going to be interesting to see how the market unfolds. And also, one of the questions in our investors' email was, can we take advantage of these opportunities? And the answer is, of course,
yes.
Absolutely. We will and have been taking advantage of these opportunities. I mean, the property I'm sitting in right now is an unbelievable purchase, and this property will never, ever, ever be worth this price again. I just know it. And that was a function of...
It wasn't worth the price when we bought that price, to be honest.
Correct. So we got lucky. You could say that we were at the right place, right time. It's just a function of the market. The market presented this opportunity, and that's what we're going to be continuing to do moving forward.
Yeah, and we want to buy at every point, at every year, all the time, at least a deal a quarter, is what we want to be providing to our investors, the opportunity. Time in the market, not time in the market, as we talk about. You put a logical debt and equity structure on the deals. We're in the business of trying to have everyone sleep well at night. Perhaps here and there we'll have a riskier business plan, but generally speaking, we want to put sound, logical choices and decisions together to buy the best deals possible. With that said, thank you so much for listening to this week's podcast. We will see you next week, and we will not miss a show for a very long time. Peace.